we should absolutely consider the most fundamental of these aspects. All right, and that has to be run through an assessment of whether it's time to be risk on or risk off, whether we should be going for carry trade or not, how interest rate expectations are shaping the expectations of the Aussie USD's outlook for the entire market. All right, this is something that we can apply not just to the Aussie USD. It's a very obvious pair, as would any kind of high-yield currency pair like a Kiwi USD, Kiwi Japanese yen, or a Kiwi USD, New Zealand dollar US dollar pair. All right, this one is much more interesting for its interest rate perspectives, which it's expected to face very high yield increases in the coming 12 months. All right, we could also apply this, however, to benchmarks like the Euro USD. And we can even apply it to individual currencies like the dollar index itself. All right. We have to take this in a certain perspective, however. We have to look at this from the more rudimentary, fundamental perspective. First, what are we doing? We are looking at risk trends, we are looking at carry trade, we are looking at interest rates and interest rate expectations to establish if a currency and currency pair is under or overvalued, and whether it will continue in its given bearing. All right. Now, two ways we need to look at this. We need to do this. There's two aspects to this approach. One, we need to establish the market's balance of risk appetite. Risk off, risk on. Is there an appetite for yield, or is there more of a concern of volatility and the fear therein? All right. That's the first step. The second step is then to find undervalued currencies, given that scenario. And whether we're talking about undervalued or overvalued very much depends on step number one. All right, so let's take this step by step. The first step we're going to take is to first establish the market's balance of risk appetite trends. Now we have a range or a spectrum of safety to risky. All right. Now, risk is only an assumption from more of a pessimistic view, not necessarily pessimistic, but risk is a risky view. All right. At the same time, risk is not just risky; it also provides a significant return to compensate for those risks. Safe havens, which face very little risk, are low yielding, and we call them funding currencies in the carry trade. Spotting a currency or an asset on this spectrum is important because when you're making an FX pair, you want to find a pair that does have an exposure to those risk themes, and you want to set up a high-yielding currency versus a low-yielding currency or a safe haven to garner a stronger reaction, a stronger sensitivity to those themes. If, on the other hand, I chose something like an Aussie Kiwi or a dollar yen, those pairs are not going to be as sensitive to the risk establishment. However, we can still see that removing that risk theme by selecting a pair that's closer on the spectrum and removes that risk element can actually still give us a pretty straightforward trade. We just don't have to look at the risk element as closely. We can look at the other aspects, which will take us into interest rate expectations. All right, so that tells us where we are on the spectrum. But how do I usually establish risk trends? Well, there's actually very complicated, and there's a very easy way to do it. The complicated way is to look at the presumed reactions and relationships between different asset classes. I like to look at the US dollar, I like to look at the S&P 500, I like to look at global equities, I also like to look at particular commodities that reflect sentiment very well and the need for a safe haven, gold being a very good one. All right, but the easy way of doing this is actually, at this point in time, just looking at the S&P 500 or U.S. equities. Why? Because not only is this a reflection of most investors' sentiment, it is also a measure of faith or conviction in stimulus. And stimulus has been a very big secondary provider for an otherwise absent fundamental backdrop. Right? And it has kept capital markets rising, has kept investors putting their money into the markets. Right, so the S&P 500 can be my measure. As you can see here, risk trends are still relatively robust, though there is reason to doubt that its underlying strength. If you look at some of those relationships for those different asset classes, like global equities are not as prolific in their support for the rise, and definitely from the FX market, we are not seeing the same level of certitude and appetite for yield. So risk trends, risk balance, is one aspect of trading the carry trade or trading interest rate expectations when we fold that in. But the second element is to find undervalued currencies. Now, first we have to establish, do we have a market that is risk on, or one that's seeking yield and is less concerned of volatility and the fear therein, or we are talking about risk off, right, where people avoid yield, that's not their concern. Their concern is to actually find safety, right? If we are looking at a risk on, we want to find undervalued carry currencies. All right, so we want to find undervalued high yield currencies to go long, and we want to short safe havens. All right, overvalued safe havens. Risk off, you want to go long undervalued safe havens and short high yield, overvalued high yield currencies. All right. I'll linger on this this picture just a second, just to get a sense of it. But with that sense, we know what to look for. Okay, when I look at the S&P 500, let's say, and I can see that there is a risk-positive element. This continues to drive forward. If there were to be something that really supports the continuation of risk and proliferation of risk in other markets like Asian, European equities, into commodities like oil, and into very particular commodities like gold, then we would likely see a more significant continuation of risk trends. If that's the case, I want to start looking for a undervalued high yield currency and an overvalued safe haven. Aussie USD actually fits that bill quite nicely. You can see where the Aussie dollar is at in its historical levels, and it just has seen a significant rout in interest rate expectations. The market was, until recently, expecting aggressive rate cuts from the Australian dollar. All right. Subsequently, those have pulled back, whereas the U.S. dollar, especially after the confirmation of stimulus in QE3, is coming off of significant highs and still can continue to drop as long as risk trends are positive and rising. All right. So this Aussie USD establishes a currency pair where we have an undervalued high yield currency and a overvalued safe haven. The same general assessment can be made of something that goes to the yen crosses. Kiwi yen is a step lower. The yen crosses in general are overwhelmingly expensive. All right, so the yen as a safe haven is cheap, and the Kiwi dollar, which has actually seen an interest rate expectation really bloom in recent months, is somewhat overvalued. So this is not as attractive as an Aussie dollar on a risk-positive theme. You can do this for the Euro USD. All right, is this undervalued? Is the euro looking at a stronger interest rate forecast? Is it a good high yield, high return kind of currency? Not necessarily. And the dollar is actually particularly weak here. So this is not a preferred pair to the long side on a risk-positive theme. All right? So as you can see, you can work these scales of first establishing risk trends, establishing where we are on those risk trends with currency pairs, and then finding overvalued and undervalued pairs. All right? Doing those two steps will help sort the pairings for you. There's many opportunities for major themes like a risk-on or risk-off theme, but you have to establish which one is the better opportunity. All right? Now, I chose a few pairs to look at this a little bit more closely, and also to introduce you to the expectations of interest rates versus current interest rates. Here we have the Aussie yen, which we just looked at. All right? The yield differential is quite strong here. You can see that the Aussie and yen, this is actually based on 2-year interest rate, 2-year benchmark lending rates. You can see that there is a very substantial yield gap here. approximately 2.5%. That's a high level of return. If you do something like a euro yen, it's essentially zero. All right, so this is a very significant rate of return. And a common question that comes up, well, I'll call it a frequent question, that comes up to me is, why doesn't the Aussie yen just continue to rise as the interest rate is already clearly very high? We have to assume that investors have a tipping point. Maybe 2.5% isn't enough for one investor to put their money into this long Aussie yen trade. Maybe they need 3%. So when we get up to 3%, a new wave of capital comes into this trade. And obviously as the capital comes in, it drives the exchange rate, the Aussie yen, higher. Okay? There's also a very important aspect in the interest rate outlook. Right? A lot of people look at just the current interest rates and think that that establishes the current bearing and the continuing trend of that exchange rate. It doesn't. If you look at the Aussie yen, we already know that the interest rate currently is 2.5%. Now investors are already aware of this. They're not going to continuously inject more funds in there because they see it's 2.5%. They've already made their investment decision. But if they think in the future that the interest rate will rise, they will start putting money in, right? Because they want to get in when those assets that provide the yield are cheaper. So they get in ahead of time, see the interest rates rise, and subsequently you also see the exchange rate rise as that capital is put in to take advantage of the yield increase. Here is a differential between the yield forecast. All right, you have here the Aussie yen, the RBA's interest rate forecast versus the Bank of Japan's interest rate forecast. We are recovering. This is a recovery. There is essentially zero interest rate forecast from the Aussie yen. That's because the RBA just came off of very significant rate cuts. Right? And that forecast is showing a very strong correlation to the Aussie yen, because investors who were fleeing the Aussie previously because of those rate cuts are starting to pull their money back in as the interest rate forecast turns to flat or neutral and then eventually to positive. Now the RBNZ, the Reserve Bank of New Zealand, is another interest rate forecast that is very interesting here. They have actually been looking at significant rate hikes over the coming 12 months. However, recently we've seen those interest rates pull back. As much as 100 basis points expected to be hiked over the coming 12 months back in September. It's pulled back to almost 59 basis points. Right, so it's stabilized a little bit. But interest rates are high, and yes, they are still expecting rate hikes, yet the Kiwi yen has still seen two legs of pullback here. A lot of people are confused by this. They say interest rate expectations are already positive and interest rates currently are very high. Why does the Kiwi yen pull back at all? Because we expect that the markets are already positioning for what is already currently the yield and what the prevailing expectation is for the yield. As those expectations or those yields change, the market changes its position on net. Okay? These are two very important themes, and they generally speak to the same overall structural changes that we see in positioning, but they are critical to understanding the basic fundamental principles of the FX market. Hopefully this clarifies it a little bit for you. Good luck trading out there, guys, and we'll do another Forex strategy video tomorrow.